As we head into the new trading week, the U.S. markets are currently closed. The final figures from the session on Friday, November 7th, 2025, put Airbnb, ticker ABNB, at a close of $120.88. That was a modest gain for the day, up $0.35 or just about 0.29%. But that simple closing number, that small green print, hides the absolute chaos that happened underneath the surface. This is the reality that most investors missed. The expectation, following Airbnb's mixed third-quarter earnings report last week, was for weakness. The company missed profit estimates, and in this market, that's usually a one-way ticket down. The stock opened Friday's session much higher, near $125.50, and then proceeded to fall off a cliff. It cratered, hitting a low of $117.15. That's where the story was supposed to end, a validation of the earnings miss, a confirmation of bearish sentiment. But then the reality changed. Buyers stepped in at that 117 level, and they stepped in with force. The stock spent the rest of the day in a brutal fight, clawing its way back almost $9 from its intraday low to finish positive. This wasn't a quiet drift, this was a battlefield. It signals a profound disagreement in the market about what this company is actually worth, and that $117 level has now been established as a serious line in the sand. Let's establish the common ground, the expectation everyone shared. Airbnb reported its Q3 numbers, and the headline was a miss. Earnings per share came in at $2.21, but Wall Street was looking for $2.31. In an environment where companies like Nvidia stock are expected to beat and raise every single time, any miss is punished. The initial after-hours reaction was negative, and the stock looked vulnerable. The narrative was simple: growth is slowing, profits are disappointing, and the post-pandemic travel boom is officially over. Many traders likely placed their bets on that narrative, perhaps using platforms like interactive brokers to short the stock at the open, expecting it to revisit its 52-week low near $100. They were watching the macro picture, seeing reports of slowing U.S. travel and price-sensitive consumers, and they thought this EPS miss was the catalyst for the next leg down. But the reality that unfolded on Friday was far more complex, and for the bulls, much more encouraging. While the profit number missed, the market eventually decided to focus on what went right. Revenue actually beat expectations, coming in at $4.1 billion. Gross booking value, a critical metric showing the total value of bookings on the platform, jumped 14% year over year to $22.9 billion. This wasn't the picture of a company collapsing, it was the picture of a company facing headwinds but still growing its core operations. What Friday's violent reversal from $117 tells us is that a significant contingent of institutional investors, the kind who manage funds through Fidelity Wealth Management or build long-term positions, looked at that $2.21 EPS, shrugged, and then looked at the 14% booking growth and the $4.1 billion in revenue and decided that the sell-off was overdone. They absorbed the selling pressure from the short-term traders and the retail investors panicking on their Robinhood app and established a new floor. This leads us to the critical tension in Airbnb stock right now. The company is no longer the high-flying growth monster of its 2020 IPO. It's a maturing business in a tough economic environment, and it's priced like it's still a growth story, with a P/E ratio near 29. This is where the analyst community is completely split. The consensus rating is a hold. This isn't a buy like Apple stock often enjoys, nor is it a high-conviction bet. It's an institutional shrug. You have firms like Wells Fargo setting a target as low as $111, seeing the regulatory and macro risks as overwhelming. Then you have others looking closer to $145, believing the international expansion story. This split is why the stock is coiling. It's trapped between a slowing, risk-filled present and a potentially profitable, diversified future. The performance year-to-date tells this story of frustration. While the S&P 500 has churned, Airbnb stock is down over 8% in 2025. This is especially painful when you compare it to its travel sector peers. Expedia, EXPE, is up nearly 18% year-to-date, and even Booking Holdings, BKNG, is only down about 1.4%. Airbnb is the clear laggard. This underperformance is a major source of tension. Investors who bought in using a SoFi Invest account, hoping for a repeat of the tech booms, are left holding a stock that's trailing the old guard competitors it was supposed to disrupt. The short interest reflects this skepticism. Recent data shows around 21 million shares are held short. That's not an astronomical number, but it's a significant bet that the stock has further to fall, representing several days of average trading volume. So what does Airbnb actually do? It's crucial to understand its model. Airbnb is an asset-light platform. It doesn't own the properties, it acts as a trusted middleman, a marketplace connecting hosts, people with a spare room or an entire property, with guests, travelers. It takes a percentage from both sides of the transaction. This model gives it incredible margins and scalability that hotels can't match. In recent years, it has tried to expand this model beyond just stays into experiences, allowing people to book local tours, classes, and activities. This is a key part of the bull case, that Airbnb can become an end-to-end travel platform. The company's management has been aggressive, executing a $900 million share buyback in the third quarter, a clear signal that they believe their own stock is undervalued at these levels. This brings us to the future outlook, the catalysts versus the risks. This is the whole ballgame for anyone considering an investment in ABNB. The primary catalyst is international growth. While the U.S. market, which accounts for nearly half of its bookings, is showing signs of softness, markets in Latin America and Asia are exploding. First-time bookers in Japan and India grew by 20% and 50% respectively. This is where the new growth is coming from. The second catalyst is the expansion into new services. The Reserve Now, Pay Later feature is proving sticky, with management noting 60% uptake from eligible users. This directly combats the hotel industry's main advantage, paying at checkout, and is helping drive bookings. The push into experiences is a longer-term play to capture more of the $300 billion global tours and activities market. Management is also investing heavily in AI and product improvements to reduce friction, which they believe will protect their margins. But the risks are as large and they are existential. The number one risk, and the one that keeps long-term investors up at night, is regulation. This is the bear case in a nutshell. Cities around the world, particularly New York, are cracking down hard on short-term rentals. This isn't a minor headache. Airbnb itself has warned that in 40 of its most significant cities, it still lacks workable regulatory solutions, putting as much as $1 billion in revenue at risk. This is the dark cloud that hangs over every earnings report. Here's a question for everyone watching. Comment below. Do you believe major cities will ever find a long-term, workable regulatory solution for Airbnb, or is this a permanent risk that will cap the stock's potential? The second major risk is the macroeconomic environment. We are in a period of slowing growth and high price sensitivity. The U.S. Travel Association projects that international inbound travel to the U.S. will actually decrease in 2025. That's a direct hit to Airbnb's most mature market. If a full-blown recession hits, discretionary travel spending is one of the first things to get cut. People will stop booking weekend getaways, and that flows directly to Airbnb's bottom line. Finally, there's competition. Booking Holdings is a formidable, profitable machine that also has a massive alternative accommodations business. Expedia is resurgent. This isn't a one-horse race. For many investors, putting their capital into a diversified basket of Fidelity mutual funds or Fidelity ETFs that hold the entire consumer discretionary sector might feel safer than picking a winner in this brutal fight. A hands-off investor might just use a service like Schwab Intelligent Portfolios to get exposure without the single stock risk. This isn't like the early days of Tesla stock, which had the EV narrative almost to itself. Airbnb is in a knife fight with entrenched, powerful incumbents. So, as we wrap up, we're left with that Friday trading session as a perfect microcosm of the entire Airbnb story. The expectation was a simple, punishing slide based on a headline EPS miss. The reality was a deep, violent plunge followed by an equally determined rally, showing that a powerful base of buyers believes the long-term growth story, driven by international expansion and new services, is worth more than the short-term regulatory and macro risks. The stock at $120.88 is balanced on a knife's edge.